Welcome, Market Rebels! Well, some trades look great because the chart looks obvious. That's exactly the trap. In this episode, we'll talk about why markets don't reward visual interpretations of charts and why feeding the seagulls is really mistaking images for information. Stop feeding seagulls. In the summer, Florida beaches are packed with tourists. While they do add to the traffic, they greatly add to the entertainment. Men wear black dress socks with flip-flops, just in case they need to run to an emergency board meeting. Women wear large floppy hats that block the sun for an entire zip code. And why carry a cooler when you can roll a suitcase in the sand? But after they've settled on the beach with their hotel bath towels and airline neck pillows, you'll notice something else. Tourists don't feed fish. They feed seagulls. It's not that seagulls deserve it, but it's because they're loud, obvious, obnoxious, and right in their faces. Seagulls, after all, have learned that if you want bread, look for black socks. But while all the action is taking place in their faces, they don't even realize that treasure lies beneath the sea. Traders make similar mistakes. They don't search for value. Instead, they react to whatever flaps, screeches, or swoops across their screen the loudest. Oh look, a stock is forming a pattern. It's a flag. No wait, a one-legged flamingo. Or maybe, just maybe, if it breaks this line, it'll turn to a cliff-howling coyote. I have to buy. Many of these technical patterns feel like great information because it's visible. And when it's visible, it feels true. But markets don't reward eyesight. Markets reward insight. Insight begins the moment you stop trusting what jumps out at you and start questioning why it jumped out in the first place. Traders think they're trading on insight, but if it's something you see on a chart, it's hindsight, and markets don't pay for that. Trading isn't about pattern recognition. Traders think they're playing a game of pattern recognition when in reality they're playing a game of adversarial payoff extraction against other traders. What does that mean? It means that all the gains and losses must sum to zero. One trader's gain is another trader's loss. Even though everyone may see the same picture, they can't all profit. It's impossible. Technical analysis versus trading is the difference between watching a football game versus betting on it. The football game you're watching is completely different from betting on it. For traders, technical analysis may be the game on TV, but trading is the betting market. For trading, you're not paid for correctly identifying the formation on a chart. You're not paid for knowing whether a pattern looks bullish or bearish. You're not paid for being right about momentum, support, or resistance. You can argue all day, whether it's a flamingo or a coyote, it won't make a bit of difference. You are only paid if, and this is important, your interpretation is better, faster, or more informed than the trader taking the opposite side of your trade. Technical analysis gives the illusion that if the picture is bullish, then all traders who currently identified it should be profitable. But again, the market doesn't reward the interpretation of the picture. The market rewards your ability to buy from someone who is too pessimistic, sell to someone who is too optimistic, be earlier than the crowd, and most of all, avoid being their liquidity. Just like a football bet, you may correctly identify the winning team, but still lose the bet. They're two different things. If you're trading options, the game isn't about the picture on the chart. It's who interprets the picture relatively better. If your interpretation can be found on hundreds of YouTube channels, Wikipedia, or even by asking a tourist wearing black socks on a beach, it's not information. Markets don't pay for what you know. They pay for what others don't know. If an average person can Google it, it isn't an edge, it's in the market price. Why traders mistake pictures for payoffs. Human brains are built for visual storytelling, not adversarial payoff math. That's why stories stick, math doesn't. Patterns give a sense of control, predictability, expertise, and most of all, a sense of reward for being perceptive. That means a breakout isn't a bargain, it's a consensus. A breakout simply shows that buyers are motivated and trend followers are joining in. By the time the pattern is obvious, the trade is no longer cheap. You're buying at the worst possible price because everyone can see that too. It's expensive because you must now outperform what the market already expects. It's a crowded trade where all the seagulls are, disguised as a signal. In order to profit, you need to see something the crowd missed. You need an extra surprise to profit. That means you need different information, not common knowledge. Common knowledge has no value. You may know that a touchdown is worth 6 points, but that knowledge won't help you to beat the spread. Why? Because everybody else knows it too. That seems to make sense to traders, yet they'll continue to look for chart patterns that everybody knows, thinking it gives them an edge. If both are public knowledge, why would one be an edge when the other isn't? If you could bet in real time, you shouldn't think you have an edge just because you can see the team is likely to score. If it's visible to you, it's visible to the world. There's no secret pattern that only you can see. If it's on the screen, it's in the price. If it's in the price, it can't be an edge. When a football team lines up with a first down on the 5-yard line, you can't bet at pregame odds. You can't bet at midfield odds. Instead, you must bet at the probability they score is extremely high odds. However, most traders approach the markets the wrong way. They spend time learning what everybody else already knows and think they can beat the averages by doing what the average trader is doing. If you want to become a professional football gambler, don't spend your time memorizing NFL rules. Memorizing Fibonacci levels is like knowing NFL rules. Everyone knows them, and the odds fully reflect them. Fibonacci stock levels aren't a secret. They've been used since 1938 when Ralph Nelson Elliott wrote about them in his book, The Wave Principle. They're nothing more than a yard marker. But what if you're glued to CNBC and riveted to stock charts and real-time tick data? Doesn't that give you an edge? Who could possibly be ahead of you? Chasing Formula One cars on a bicycle. If you think you can log on to your E-Trade account using high-speed internet and enter a trade based on a chart formation you're seeing, you're severely underestimating your opponents. Most high-frequency trading, HFT, quant funds require a PhD in math, physics, computer science, or electrical engineering, and with some salaries reaching $5 million. They have near-instant execution with computers optimized by co-location and lightning-fast connections. They often hold positions for seconds or fractions of a second, and some can move billions of dollars worth of transactions in a single day. They're operating at 50,000 times the speed you could ever dream of. You're trying to chase a Formula One race car going 220 miles per hour on your beach cruiser. By the time you see that coyote pattern forming, the quant funds already had it priced, hunted, and stripped for parts. They're on to the pattern you'll notice next week. News headlines, support, resistance, flags, pennants, wedges, and Fibonacci levels are all visual candies. They satisfy the part of the brain that believes skill comes from seeing the right thing. Thinking probabilities in different dimensions. Whether you're trading stocks or options, you must think about probabilities, but for different reasons. Stock traders just think up or down. It's a one-dimensional bet. You make money if it rises and lose money if it falls. Options, however, are a completely different game. A call option doesn't answer the question, are you bullish? It asks, are you bullish beyond the expectations already priced in? If a $100 call is priced at $5, you need the stock to rise to $105 at expiration to break even. The stock trader would be up $5 on that same move. Just like sports betting, an options trader is betting that the stock will rise beyond the spread baked into the options price. Stock traders who become options traders think they've switched products, but really they've switched rule books. It's like saying you're an expert checkers player, so if I switch to chess, I'll do great. It's not the same game. Stocks reward direction, options reward outperformance versus expectation. If you're right and the entire world underestimated the move, then you win. So to succeed with options, professional traders think about probabilities. You must think about ranges of probabilities rather than predicting the spot where the stock will land. But that requires you understand implied volatility, not pictures. If seeing pictures were enough, the richest traders would be photographers and artists. Identifying a pattern and getting a profit doesn't mean the pattern caused it. Thermometers don't create fevers. They just show where the heat already is. Likewise, chart patterns are a side effect, not a source. Stop feeding the seagulls like a tourist with a bag of bread. Instead, ask the only question that matters. Who is paying this price and why? Watch the seagulls if you'd like, but don't confuse motion with meaning or noise with profit. The real treasures lie beneath the ocean, in the hidden depths of volatility, where value is shaped by probabilities, not pictures. Next week, we'll take this idea one step further. If charts are just pictures, then prices are not about who's right. They're about who everyone thinks everyone else will agree with. Join us for Bulls, Bears, and Beauty Pageants, Why Markets Move on Perception, Not Truth.